Okay, so today we are going to be covering an important topic. Now, my channel is primarily about investing, but there are many different elements when it comes to personal finance. And I want us to be on point and successful and thriving in all areas. So, I have a special guest here with me today, and we're going to be talking about building and repairing credit. And I'm going to let him introduce himself. He is a fellow YouTuber with over 120,000 subs, but I'm not going to say any more. Here we are.
Hey, hey, how are you, Lisa?
I'm good. Please
All
introduce
right.
yourself.
Yes, yes. First, I want to say thank you so much, Lisa, for having me on. For those who don't know, who have ever seen me, my name is Calvin Russell. Of course, like Lisa mentioned, I am a fellow YouTuber as well in the finance space. And essentially, on my channel, we talk about pretty much all aspects of credit education. So, if you're rebuilding credit, if you're new to credit, if you have a high credit score, but you don't know how to maximize that score, that's what we talk about. And occasionally we talk about different facets of finance, and that's where we bring in Lisa from time to time as well too. So that's the intro.
Okay, thank you.
Sure,
So,
sure.
Calvin, we were both at Vid Summit, but I never
Yeah.
got the chance to meet you in person.
Man.
But I'm glad that we could have connected virtually. We
Yeah.
discovered each other's channels and
Yeah.
we're able to collaborate in this way and bring this information to our communities.
That's right. Absolutely.
Yes, yes. Okay, so let's get started with our questions and our topic of the day. So, how does somebody get started? What is the first step? I know in my
Yeah.
household with my girls, the first thing that I did was to put them down as an authorized user on my credit
Yeah.
card. So, that was their start to building their credit score. We weren't even like trying to track it or anything. I just was doing that, but it wasn't until my oldest daughter was, out there in the world that we saw the results. We saw what
Yeah.
it created. So, what is the first step for someone that is just getting started with trying to build their credit or doesn't even know what their credit score is?
Yeah, no, that's an amazing question, and it's great that you mentioned that as well too. And also too, applause to you for adding your daughters on your credit cards at such an early age as well too, because that's going to set up the foundation. So let's talk about that. So when a person is essentially looking at their credit score, there's a lot of different credit scores out there. So let's break a couple things down. Number one, the algorithm that is used the most is what we like to call the FICO score. Okay, that's
Mhm.
FICO, and that stands for, it's actually an abbreviation for Fair Isaac Incorporation. And that scoring process has been out, since the late, I would say, like the probably mid '80s, and it's been that way for years up until about I would say about 2015, 14. And then that's when Credit Karma started to take off. Now, Credit Karma is really the software company that is known for using the essentially the competition to FICO, which is also known as the Vantage score. But a lot of people don't know that that Vantage score is actually used by CreditWise through Capital One, WalletHub.com. If you've ever purchased a credit score from TransUnion.com or Equifax.com, that's a Vantage score. So if you ever, usually most free credit scores are Vantage scores, even CreditSesame.com. So a lot of times when people look at those credit scores, they'll go to the dealership and they'll say, they'll get their credit, pulled, and they'll say, well, man, I this isn't the same score that I saw. And so because of that, now in 2025, the mortgage industry is going to be rolling out approvals. And that's just one of the many changes in 2025. But that's where you have to start there. The reason why I brought up all of that is because I didn't want to make it seem like the Vantage score is watered down. It's most definitely going to be neck and neck, with FICO by the end of the year. So you can go to myfico.com to see all of your scores. I say all of your scores because some people think you have just three scores. You have Equifax. The main credit bureaus are Equifax, TransUnion, and Experian. When you look for a home, that's what they pull. When you go to try to get a car, a personal loan, an apartment, anything, though, they're going to look at those three, or if not one or two of those three. Now you can do that through my FICO. Now what I recommend is they have paid plans. That's another reason why Vantage Score is on the rise, because Vantage Score is free. Vantage Score is actually owned by the credit bureaus. A lot of people don't know that. And but there's a lot of politics going on in behind the scenes. But that's where you want to start. But you could always, just look at your score for free at creditkarma.com. But again, that's going to be a different algorithm. Less than 10% of financial institutions even use that algorithm. And I mentioned that because again, by the end of the year, that's most definitely going to be changing. But if you want to buy a car one day or in the future or in 2025, whatever, you need to see your your FICO auto loan scores, because that way you can see exactly what the dealership is looking at. If you want to buy a home in 2025 or later down the line, you can see your FICO mortgage scores from myfico.com. So if you want to see what the industries are looking at before you even apply, that's where myfico.com is going to come into play. So you really want to start there.
That's interesting that you're
Yeah.
saying specific ratings
Yeah.
for your different needs. Okay,
Yeah.
all right. So yeah, things have changed. Even if you thought you know, and this is just a few years ago. So
Yeah.
yeah, you think you know, but you may not because
Yeah.
things are changing and evolving. So
Absolutely.
what would be an ideal? I know you mentioned the dealer, and
Yeah.
your knowledge started out as working at a car dealership, correct?
Absolutely. As a
Yeah.
matter of fact, yeah, I was at a dealership for 6 years, and 4 out of those 6 years, I was in sales, and I sold 550 cars in less than 4 years. So I was always a top salesperson there. And not number one, but I was always in the mix. But it wasn't just that for me. It was more so I was actually more interested in the people that did not get approved. Not that I was greedy. It was just more so like, you see a lot at the dealership, and I'll never forget. There was this one lady that came to the dealership. Well, I'm sorry, she called the dealership first. It was like at 2 p.m. And she was like, "Hey, I've gone to quite a few dealerships. I can't get approved. And, I just want to know, I heard you all had a second chance program. It was a program that I had started at the dealership. They had me do ads on the radio for it, all this stuff.
Mhm.
And she says, I heard about it. I want to stop by the dealership. And then we said, okay, great. And so I was still kind of fairly new at the dealership at the time. She came to the dealership, but I didn't know I didn't know, I assumed she was going to come by herself. She came with about 4 of her kids. So it's her and her kids. Mind you, I'm in a car dealership. So she didn't have a car. So she took the bus. Okay. Now the dealership closes at like 9 p.m. She got there at like 7 p.m. You think you got a 2 hour window, but if your credit's not the best, you never know what's going to happen. So she gets there, and sure enough, we show her some cars, and we send her application to the bank, and all the banks denied her, every single one of them. She had money down. Her credit score wasn't the best. I think it was in the low 500s or something like that. And that was probably one of my first instances where I really felt for someone, because she had to get back on the bus. Not only that, but it took us we had one bank that was just taking forever to give us an answer, either
Mhm.
yes or no. And they literally waited till like about 8:50 at night, or 8:51, something like that at night. And they said no. And by that time we're closing. And now the buses are running every hour or so. So it was like, hey, we got to hurry up and get this lady out with her kids. And it was kind of cold outside. They got to put on coats. So we were luckily, she was able to catch the bus in time. And I say I think that was one of the first days I said to myself, people should know what to do before coming to the dealership. And not only that, but know what the banks are looking for. No one tells people what the banks are looking for. Now, mind you, this was like 2015, 2014, 2015. And so I said, you know what? I'm going to start giving people the information that they need to know. And so I made a video, and that video at the time, it was on a platform called Periscope. I don't know if you remember Periscope. You remember
Yeah,
Periscope, Lisa?
yeah.
Yeah.
I wasn't a fan. I wasn't a fan.
Right, right. And one of the things that people hated about Periscope, because listen, for all the young people in the room, Periscope, or for those who may not remember, Periscope was a platform that you could put a video on, and but it would expire in like 24 hours or 48 hours. And so, but it was a hot thing to do. So I made a video. I told everybody on Facebook about it. And I was just thinking, like, man, people would be excited to watch this video. And believe it or not, about 20 people watched that video. And the title was How to Buy a Car with a 650 credit score or lower. And I feel like, okay, like that should be like a good amount of people, right? But then it wasn't, but then I created a problem. And it wasn't the 20 people that saw it. It was the people that said, hey, I wanted to watch it, but I fell asleep, or I had to do something, or I forgot, whatever. And then so I put the same video back up again. And the people who told me the previous time that missed it, they were able to catch it. But then a new group of people said, hey, my friend told me about this video or whatever. I'm about to go to the dealership this week, and I'm trying to buy a car with a score that's under 650, but I missed the video. I said, I'm not going to keep posting this video.
Mhm.
So I said, there's got to be a video platform out there where I could just put it on a platform and not have to worry about it. I was like, duh, YouTube.
You
And I was
came
like,
over to
okay.
YouTube. Okay.
Yeah, and so that was my first video that I posted on YouTube. Oh my god, it was like the worst. Like, to me, knowing what I know now, it took me like 20 seconds to even start talking. Like, it was just getting I had pressed start and I didn't even know the video was like recording. I'm still setting up. I'm like, oh, okay, all right, let's. It was crazy. So, and
Well,
that video
we've
is
all come
still.
a long way. We've all come a long way in that department, Calvin.
We had, man,
Um,
and but that video still has like 54,000 views. But the amount of people that I've helped, not just with that video, but we now have over 1,800 videos. We've serviced over 10,000 clients nationwide. And it's just been crazy, so, and but that was like how everything got started. Yeah.
So let's try to give an like a guideline, an outline, steps, a few steps that people can take to make sure that they are on track and making sure
Yeah.
that this is a part of their financial journey that they know how to handle.
Yeah.
So what do you do
Yeah.
to start? You should request you every at what age someone you're talking to someone at what age, whether they're
Yeah.
looking to buy a car or they're interested in doing a purchase or getting an apartment, whatever it is. If
Yeah.
they don't have anything going on, at what age should you request your credit report and be mindful of it and just be ready to adult and be in
Yeah.
this part of what's going to be needed later on.
Absolutely. It continues on what I just said. You want to start off by ordering your credit report. Or again, you can start off on Credit Karma. That's fine if you want to go the free route, just to get an idea. The report is going to be the same. The scores are going to be different. Vantage score on Credit Karma versus my FICO. That way, at least you have an idea of where you are. So that's number one. Then number
So what
two,
what at what
yeah,
age would you say to do this? At like
18 years old.
17, 18
18.
years old? Okay.
Yeah.
Okay.
So even though a person could technically build credit, they really can't see it become established until about 18. And
Okay.
the reason is because the website is going to see that you're under 18, even if you do have a social, and
Mhm.
it's just going to it just won't allow you to log in. Because that's when things, even though, like, for example, you have your children on as an authorized user on the credit card, that history will show up on their profile, but the profile is not created. So it's kind of stored, attached to their social. And then at about 18, that's when they're able to start seeing that.
Okay.
Yeah.
So, all right. So they know what their score is
Yeah.
and whether it's someone made moves like I've been making or
Yeah.
not. So what is the first step? What is a card or a loan or something that they can
Yeah.
do on their own to get started with building their credit score?
Yeah, so there's a lot more accounts that a person can get nowadays versus back in the day. It really wasn't a lot of options. So, but the categories are still the same. So essentially, there's only two types of accounts that show up on credit reports. You have revolving accounts and
Mhm.
installment accounts. So revolving accounts are essentially what it sounds like. It's always revolving. It's always changing. Those are credit cards. It's essentially where you may have a credit limit, and then you're able to swipe a card, and then you pay the money back, and that revolves. You may get a credit limit increase, or they may even decrease your credit limit. So, but you want to have a mix of revolving and installment. Now, installment accounts are usually going to be accounts that end in the word loan. So, personal loan, student loan, mortgage loan, auto loan, those types of things. Those are the traditional accounts that you have. And those are kind of just going to happen just throughout life. You get an auto loan, you get a mortgage loan, you may get a student loan, things of that sort. Now, in today's time, you can also get what they call credit builder accounts. Okay. And those credit builder accounts, those are going to show up as installment accounts as well. And it looks like you're borrowing money, but you're really just kind of paying into, you're pretty much paying into a secured loan. And at the end of that term, they give you the money back that you put into it. So that blew up probably around like 2015, 2016. And now the first company was Self Lender. Then they changed their name to Self for legal reasons. And then the company that they used to do business with, that was actually the bank, was Austin Capital Bank. And Austin, essentially they got into it and some politics happened. And Austin Capital Bank started their own, and that became Credit Strong. So kind of like a lot of people don't know, first there was AT&T, and then they had a spinoff, and one of the spinoffs ended up doing pretty well, separated from the company, and that became Verizon. So a lot of times you get these spinoffs and they just kind of create their own thing.
Okay.
Yeah.
Okay. So that last one, that last scenario sounds like
Mhm.
something that someone who's already gotten off track might have to resort to. Do
Yeah,
you agree or
yeah, correct. It's nothing wrong with it. I
okay,
tell
all
people,
right.
yeah,
But
even people in the 700s or depending on where they are, but most definitely in the rebuilding stages or building in general, credit building for
okay.
sure.
Is there any card in particular that you would recommend for a beginner, or do you not get that specific with what you share and throughout your channel?
Oh, it's not a no, it's not a problem at all. So yeah, so I would say start off with like a Capital One card. They're
Mhm.
one of the best in the industry. So a Capital One card is essentially going to be they specialize in helping people build or rebuild. So for example, if you can get a Capital One card, I say go with them because they're a great place to start a relationship with. One, they work with people that have no credit. They work with people that have limited credit. They work with people that have bad credit. They work with people that are out of a bankruptcy. So Capital One is honestly for a lot of is great for a lot of people that's starting out. And what's so great about them is that they give you a $300 limit, sometimes 500, sometimes 1,000, depending on your credit profile at the time. Then they also let you add up to 5 authorized users as well to at no additional charge. Then they also do auto loans as well. Then, worst case scenario, if you apply for their unsecured credit card, which means you don't have to give a deposit, then worst case scenario, you qualify for their secured credit card. But it's not your traditional secured credit card. For those who don't know, a secured credit card is where you give money to the financial institution, and the money that you give them is your credit limit. So it's secured. So essentially, they don't care whether you pay or not. They already have your money. But you still obviously have to pay. And believe it or not, people still don't pay on secure credit cards when the payments due, but that's a whole nother video. But anyway, what I like about those options is that most secure credit cards are $500, $300, even 200 on the low end. But Capital One has a tier system. So they have a $50 secured credit card with a $200 limit, a $100 secured credit card with a $200 limit, and they also have a $200 secured credit card with a $200 limit. And so that would be the amount of the deposit. So you either pay 50, 100, or 200 based on your credit profile. And then if you get denied for that, because people have done that as well too, there's a
Mhm.
company called Open Sky. And for $200, they will approve anybody that's breathing. Okay. And so that's like the last final option. But those are just for credit card. We need a
Okay.
mix. Okay.
Yeah,
And a
yeah.
lot of people, what I see a lot of times when we do our custom game plans in which we look at their credit report and tell them exactly what they need to do to accomplish their goal, whether it's home ownership or whether it's buying a car or just improving their credit score, lowering their car payment, whatever. And what I'm seeing a lot of is that a lot of people don't have a credit mix or the right mix. And the right mix is essentially you want to have a certain amount of credit cards and a certain amount of installment accounts. It doesn't have to be perfect, but you want to have a little bit of both. And things are going to naturally happen. But I've met people that just have credit cards mainly on their credit reports. And, their credit score, they usually don't get to like past 820, 840, something like that, but you still have a nice score. But if you want to get to 850, then you need a minimum of 5 to 8 accounts that have been open for at least 8 to 11 years. And so that's how you're able to get that. But if you're constantly opening accounts, closing accounts, you'll slowly get there, as well too.
So with those amounts that you were mentioning of like,
Yeah.
$100, $200, I was thinking about the credit utilization. You're not going to be
Yeah.
able to use barely anything on those balances. Am I right? Can you touch
Y-
on credit utilization for those
yeah.
that need
Yeah.
to have an understanding of that? And you're answering questions before I even ask them. I'm over here
Good.
checking off
No,
my
that's great.
questions. I'm like, he already covered this.
Good, good. That's great. Yeah. So, what makes your credit score? There are 5 things that make your credit score, and the number one is going to be payment history. So, pay your bills on time, put them on auto pay. Number two is going to be utilization. That's what Lisa just mentioned. So, utilization is how much of the credit you're actually using. So, for example, if you have a $1,000 credit card, you ideally want to be 7 to 10% usage. So 7 to 10% on $1,000 is $70 to $100 usage. Okay. And what Lisa was alluding to was that, hey, if you have a lower credit limit, you don't have much room for error. Yes and no, depending on what you want to use that credit card for. So, for example, if you have a $500, let's say a $500 limit credit card or a $300 limit credit card, and you want to use 7 to 10%, you're talking $30 to $50. Okay, depending on which credit card. So, and that doesn't mean you can't spend more than that. That just means that when you do, your score is going to start to fluctuate. So if you want to see like if you truly want to maximize your credit score, which by the way, I have a free webinar and it's actually coming out in the next couple of days, and it's called How to Maximize Your Credit Score in 2025. It's a free webinar, and to go ahead and learn more about that, you can go to park850.com. We always have different things going on, 90-day home buying challenges and things of that sort. So if you want to learn more about that, just go to park850.com and you'll learn more about that. But to truly maximize your credit score, you need to be in that 7 to 10% utilization range, that usage range. Once you start getting above that, more so like over 30%, that's when you start to see your score decline, because the algorithm is saying, hey, even though you have access to it, we don't want to see you use that much of it. That doesn't mean you can't. Just know that, that your score is going to fluctuate. And I see people all the time that want to buy a home and they're inches away from qualifying, or people that want to be 700 plus and they're like 100 points away. I'm like, start off with your credit cards. Like, people have no idea that utilization has a major role, plays a major role in your credit score.
So I have a lot of questions. I know I have to narrow it down because we've been
It's all
going for
good.
a little bit now,
Yeah.
but I want to talk about things that I think might interest most of the viewers, like
Yeah.
you talked, like you mentioned, a mortgage, a car. I have another topic, but when it comes to cars, you worked at the dealer. Do
Yeah.
most people just go with the loan that the lender that the
Yeah.
dealer is trying to give them, or would you recommend trying to go to your own credit union or outside of the dealer, even if you have a pretty good credit score, as opposed to just automatically going with the
Yeah.
lenders that they present to you?
Yeah, there's actually a couple different strategies I think that could work. When I bought my wife, my wife and I, we had bought a vehicle probably like in 2021, and even with my vehicle that I bought as well too. So you could do a couple different ways. Way number one is, I'm okay with using the lenders at the dealership.
Mhm.
Certain brands will only allow you to use a certain lender, and if you're financing, okay,
Okay.
and so it just really depends, or they only use like specific ones. So one strategy, for example, would be to reach out to the dealership and have a conversation with them. People don't have conversations with the finance department, and so since I know the credit, I mean, since I know like the auto industry, I called the dealership, I scheduled an appointment with the finance manager over the phone, and I say, okay, hey, what are your rates looking like? And what scores do you need to see? Right. And so that way I know in advance what that is. I know what my auto FICO score is. I have an idea of what the prices of the vehicles are going to be. And so I'm just doing the math on that, for example, right? But then on the other side of the coin, another way to do it is to, like you just mentioned, where you can have your own finance. You can go to your credit union, you get your own financing. Here's the thing. Sometimes the dealership actually does have better financing options. Usually your credit union, most banks are not going to give you 0%, 0.9, 1.9, 2.9 on these vehicles, but the dealership may have that as an option. So take advantage of what the dealership has to offer as well too. But I think the biggest thing is two reasons. One, people can't see all the numbers and they don't ask the right questions. But mainly number two is that they don't want to feel like they're getting like someone's getting over them. And so they feel like, okay, let me go to the credit union first. Let me get that check. But the credit union may be charging you like 4%. You could have got 2% at the dealership. It's like, well, I'm just gonna go through my credit union. Yeah, but listen, forget a relationship. Who's gonna save you the most money? Anytime you're
Okay.
borrowing money, what really matters are the terms, and say, okay, what's going to make the most sense? And I even have shown people how to, they'll have a lease, but then they don't want to swap out of that car, but the lease is up, but they don't want to get another car. And then I've shown them how to turn that lease into a purchase. And so there's so many different strategies that you can do. But I would say, one, either set up an appointment to talk to the finance manager, and you could do that. What do you think the finance manager is doing when no one's closing a deal? They're sitting there just waiting. So
Mhm.
they have no problem talking to a potential client, especially if you're asking the right questions, and just saying, hey, my score is 720, my score is 650, whatever, and say, okay, what type of rates can I get if I go to new vehicle or a used vehicle on your lot? Or you can still have that conversation, come in, test drive, and then compare the numbers. Here's the thing: people don't understand. You don't have to have your credit ran to have a conversation, with the dealership. Like when you go to like a Land Rover dealership, Mercedes, something that's like higher end, that conversation is completely different, because these are people that's, number one, busy, but number two, they know how it works. They say, listen, I want to be in and out. When listen, when my wife and I we bought our cars, we were in and out. Usually the cars are waiting out front. We test drive, and I already have the numbers. We're usually at the dealership for half an hour, if that.
Can you touch on refinancing a car?
Yeah,
I've heard over the years, many times people talk about, especially in recent years when the rates were
yeah,
low, a
yeah.
home. But what are the options, or what can you touch on regarding refinancing your car if you got into a higher loan and now maybe your credit has improved, or maybe just your
Yeah.
knowledge has improved and you're like, I didn't cut myself a good deal here.
Yeah, absolutely. You know what? Sometimes it's that, right, where you don't know what you don't know. Let's say that first, right? And then number two, you have a situation where your credit could have improved, right? Where you probably got the auto loan in the 400s, 500s, 300s, low sixes, whatever. Or you could have gotten it with good credit, but the rates were just not the best at the time. So it's a lot of different scenarios. Either way, a lot of people sleep on this with their auto loan. And I don't care how long you're keeping your auto loan, unless it's like a lease and that's different. But
Mhm.
if you plan on keeping your auto loan for 6 years, 4 years, even 3 years, you should strongly consider an auto loan refinance. An auto loan refinance is easier to do than a home refinance. Here's why. Number one, there are many companies like Capital One Auto Finance, Clear Lane, which is owned by Ally. I think they just changed the name. So it's Ally Auto Refinance. You have autopay.com. That's an auto loan refinance. You also have lendingclub.com. They do auto loan refinancing as well. Your bank more than likely does it. Your credit union most likely does it. And essentially what they do is you are essentially taking that. So let's say, for example, you have a $30,000 auto loan. You've paid on it for a couple years. Now you owe, let's say, 25,000, right? So you started at 30, you're at 25,000. Okay. Now let's say 18 months has gone by, whatever the numbers are. I'm just kind of just throwing some numbers together.
Mhm.
Now you have so a year has gone by. We'll say it's a year and a half. So you pretty much got like 4.5 years left on the auto loan. What people think, they think that, hey, if I get an auto loan refinance, I have to start over the loan. Well, start over can mean two things. One, they're thinking, oh, well, I now have to go back to 6 years. You can do that. That's an option. Some people like having the bank ask for less and they pay the bank more, right? So you could go from 4.5 years left to 6 years. Now your payment is a lot lower, and the bank is asking you for, let's say your car payment was, let's say $500, $550. Now the bank is asking you for, let's say 375, 400, but you can still keep paying, that 550 and pay the car off early. So just because the bank is asking for a lower payment doesn't mean that you can't pay more. Then number two, you don't have to go from 4.5 years to 6 years. You could just keep it at 4.5 years or set it at five or bring it down to four. You could bring it down to three. Here's the thing. The faster that the bank gets their money, the lower the interest rates are going to be. So keep that in mind as well. And we talk about that in my free webinar, how to maximize your credit score in 2025, is refinancing your auto loan. Listen, you'd be surprised. 70 to 80% of people, Lisa, right now can lower their auto loan payments and they have no idea. They already qualify. But here's the problem. Um, no bank on the planet is going to do this if you do it this way. Watch this. If a person has an auto loan with, let's say, Chase Bank, you
Mhm.
call Chase Bank and say, hey, can I refinance this? 99.9% of banks are going to say no. Why is that? Because they have your agreement on paper that you're going to pay them at X interest rate. Why would they essentially why would they put themselves in a worse financial, in a position where they're making less money when
Mhm.
they already have you committed at more money? My point is that that's why banks, they don't have to help refinance. Now, credit unions, they're all about relationships. So they more than likely will help you refinance with them multiple times. But what if you're not with a credit union, right? And the bank that you have the auto loan with won't do it. That's where those options come in at. Capital One auto loan refinance, Ally refinance, Lending Club, autopay.com. Those are caribou.com. That they're blowing up with the refinance game big time. That's CARIBOU. And if you go to my website, park850.com, there's a link that shows you a lot of the things that we've been talking about as well, too, if you didn't write this stuff down. But anyway, any one of those options are going to be great for people looking to refinance their auto loans and lower their car payments as well.
Okay. I'm trying to narrow down my questions because I want to ask the questions that I think will be most impactful to
Yeah.
the viewers, you know?
Yeah.
So, another thing I want you to talk a little bit about is if you are just like the scenario we're talking about here, if you have credit cards with high
Great
interest rates,
question.
how do you go about how do you
Mhm.
go about maximizing balance
Yeah.
transfers and in the right way? I've touched on this in my own experience of what
Yeah.
I've done, but I want to hear you
Yeah.
break it down just a little bit for us on how to make sure that, even if you ran up a particular credit card, you have that high balance. Now you're battling that interest. We want to get out of that. We can't just, we don't feel like you're stuck in it. How do we
Yeah.
go about making a plan and seeking a way in order to lower our interest?
Absolutely, that's an amazing question. So, balance transfers have been out. The concept has been out for years. People have balance transfer credit cards right now and don't even know it, just because they got the credit card and they saw something say balance transfer. They didn't even pay attention to it. And some credit card companies will allow you to still do a balance transfer even after an intro APR. And usually the intro APR is like 0%. So first of all, let's break down what a balance transfer credit card is and why you should strongly consider doing it. So a balance transfer credit card is essentially a credit card that you can transfer another credit card balance. It could be a regular credit card, it could be a retail store credit card. People don't know that. And you're able to take that balance from the old credit card or the previous credit card, new or used, doesn't matter. You're able to transfer that to the balance transfer credit card. Now, why would you want to do that? Well, that's because most of them are going to have 0%. So, for example, let's say, for example, you have a credit card, it has a $5,000 balance, right? Doesn't really matter the balance, but say it's $5,000. And you're paying 18%, 15%, 20% interest, and you're carrying that balance, and you're seeing that some of your payment, your monthly payment, is going towards principal, and then some of that monthly payment is going towards interest. That's normal with credit cards. When you do that balance transfer, however, you're transferring that $5,000 over to that balance transfer credit card, and now you're at 0%. And that 0% won't last forever. It's going to be either the lowest I've ever seen was like 9 months, but usually going to see 9 months, 12 months, 15 months, 18
Mhm.
months, 21 months. And usually the higher months are usually like with Citibank. They're very big on those, and Wells Fargo, Bank of America too, actually. So, and they'll let you transfer that balance for 0% for like 18 months. And really, they want your business. They're essentially saying, hey, listen, bring that balance on over here. And for you bringing that balance over here, they're hoping that that balance is still there, because studies show that that balance is going to be there 12 months, 2 years, by the time the 0% has now expired. And now you're paying them interest. But there was a good period of time. If you strategize it right and just say, okay, now that I'm not paying any interest, let me go ahead and divide my balance into the months. So if I have 18 months, no interest, let me take this $5,000, divide that by 18 months. Now I can pay that. And I know for a fact that I'll be paid off, versus if you just keep paying the interest, you're more than likely not going to pay it off in those 18 months, because those payments are still being split some kind of way, percentage wise, with some of it going to the principal and then some of it going to interest. So that's something that you could do. I see people do that all the time. I even see some people transfer, let's say, for example, another example would be, if you have a $5,000, balance on a credit card, you get approved for the balance transfer credit card, but the limit is only, let's say, 3,000. So now you can only transfer 3,000. I've seen people say, "Oh no, I don't want that if I can't transfer the whole 5,000." I would rather pay 0% on 3,000 than, 18 to 24% on the entire five. Now I'm only paying 18 to 24% on the entire, like the 2,000 that's left over. So again, that's how a balance transfer credit card works. You don't need like a super high credit score either. You can get away with this at like 650, 680. The higher the credit score, the more you're probably going to get that credit limit on the balance transfer. There is a balance transfer fee. Because balances are kind of high right now, that fee is like 4%. And they add that to the balance transfer. Let's say, for example, again, using that $5,000 example, if you have the original 5,000 and then you get a credit card, brand new $5,000, and it has a limit on it, then you're more than likely, not only are you going to be able to max that out, but you probably won't be able to move over the entire five, because now you have to compensate for the 3 to 4% transfer fee, as well as the $5,000 that you're moving. This is just assuming that the balance transfer is just so happens to be at the limit from the original, like from what you're actually transferring over. But if you get approved for 7,000, moving over 5,000 is not that big of a deal. So just make sure that the numbers, end up laying out right. But again, you don't have to have a super high credit score to do this.
So, can you just touch on, because you're giving out different ranges and
Mhm.
different, like you could still do this if you have this credit score. Can you just
Yeah,
touch on, if you're going to buy a car or a house or apply for a new credit card, what credit score should you have, or a
yeah,
minimum should you be aiming to maintain, as an average person, even if you are
yeah.
just starting out?
Yeah, so there's a couple different scenarios. One, if you want to get a student loan, as we know, they don't care if you have good credit, bad credit, no job, no cosigner, no plan at all. That's a student loan. So we can get past that. So then you have obviously going with like an auto loan. So if you want to get like an auto loan, then preferably 650 or higher, 680 or higher, 720 or higher. The reason why I say 650, 680 sometimes is because you can still get a decent rate with that. A lot of times you'll qualify for 0%, 0.9, 1.9, 2.9, something like that, and still get a very good interest rate. Preferably you want to be in the single digits, but interest rates fluctuate. We're coming out of a high inflation interest rate market, and
Mhm.
we're still not where we need to be. But saying that to say, like sometimes it's just not there. For like all of last year, 0% just didn't exist with auto loans like it normally would. So again, but that's you're going to get the best rates available when you're 720 plus 750 plus for sure, but to get special rates usually 650 680 plus is where you want to be. That's for an auto loan. Now when you go with a mortgage loan, you only need a 580 to get the approval. A 620 is essentially going to get you an easier approval with less red tape. 580s for a mortgage score is essentially it's a little bit different though. So when you're getting a mortgage, they don't look at all three credit scores. They drop the highest, they drop the lowest, and then they choose whichever one is in the middle. The bureau doesn't matter. So if you have like a 700, a 620, and a 580, they're going to choose a 620 because that's in the middle. It's not the highest, it's not the lowest, and they use
Mhm.
that score. So you want that middle score to at least be 620 on the low end. 580 will get you in the door, and you can always refinance later. It's not going to have the best terms. They're going to be asking you a lot of questions. Underwriter's going to give you hell. So little things like that are going to play a role. Then that's essentially when you're looking to get a home, a mortgage. If you have higher student loan balances or higher student loan debt, then you could either have a cosigner or you could essentially go conventional. If you go conventional, that's a different loan type. And so you pretty much want to be like 680 plus. You could probably get away with a 650, but 680 plus if you have to change that loan type. But a lender can really break that down a little bit more. But most people try to go FHA. That's essentially where you only have to put down 3.5%. That's the lowest down payment that you could put down. So a lot of people try to qualify for that, which is that 580, 620 situation that I just mentioned. Now, what's crazy is it's actually easier to buy a home than it is to buy a car. A lot of people don't know that. And
Mhm.
so, and the reason being is because when you're buying a home, it's federally regulated. So you have a 580, you have a 620, you have the income, you're approved. Versus when you have a car, they're going to send it to all these banks and they're going to do all this stuff. They're going to say how many miles is on it, what year is it, how many drivers has it had, and then it's kind of just a toss up. Versus with mortgages, you can see what the mortgage rates are today. So they change every single day. So you're able to see that well in advance, so it's a little bit easier to navigate. Everything else, like even including credit cards, 650, 680, 720, the sevens are going to get you approved for most things, and then 800s for sure. But then at that point it's more so going to be like what made you a 600, 700, 800. Is it just one or two credit cards? You can get there with a couple credit cards, but they're going to look at what's that credit profile, what's your income, how long you've been at your job, how much are you making, how much of your credit card are you actually using, because remember, banks, they want to give you the money, but they want to make money from giving you the money. So
Mhm.
always understand that. And you also have to understand is that when people have a higher credit score, they usually have higher knowledge, of what's going on, and in most cases, and they're saying, okay, this person we probably can't make that much money off of. So the banks really make the money from the people that have the 680s and lower 650s really and lower, because they're
Mhm.
borderline. They're in the gray area. They're not really going to ask a lot of questions. They're just going to sign the paperwork. They're going to say, "Oh my God, thank you for being approved." But that's usually what the flow is going to be. I would say that's what you want to shoot for, 700 preferably, but you most definitely could do some things with the sixes for sure, like getting a home, getting a car. It may not always be the best terms, but you can always refinance or take advantage of whatever promotions that's available.
So you touched on employers, what you were just talking about. And I
Yeah.
have another question that's related to just regular real world things that you might want to be mindful of your credit score. When it comes to landlords and employers and getting insurance and stuff like that, are they really using your credit score to determine your worthiness? And in your experience, how does that impact how those things could go?
Yeah. So like if you're looking for like an apartment, for example, or like insurance, They're going to look at your credit scores for sure. That's going to determine your rates for sure as well too. I don't know too much about insurance on the back end, like what those rates are and things of that sort, because obviously it's not like an interest rate, but it's just a rate that they would charge you. They're going to charge you more, but they look at the entire profile. This is how some people with a higher credit score still may get a certain type of rate, and sometimes it's interest rates or a higher cost in general, just because their profile is light or limited, which means they only have one account or two accounts. Banks preferably want to see about 4 to 5 accounts. They want to see who else are you paying. Banks don't want to be the first one to do business with you. It's kind of like being at the family reunion and you got that one uncle that owes you money, and eventually the word gets around that he hasn't paid you, right?
Mhm.
So and that's what credit reports are for. It's like, hey, listen, they haven't paid us on time, or they haven't did this or whatever. And so that's why they look at that for sure. And the same thing goes with looking for an apartment. When they're looking at your score, the problem is with apartments is that they're not banks, so their risk factor is, oh well, I want someone to make 3 times the amount of rent, when the landlord doesn't even make 3 times the amount of rent. They can kind of create their own rules, and the assumption is if a person has a higher score, then they're going to be more financially responsible. But people know how to game the game, so they can easily be a 500 in real life with 500 credit score habits, but then on paper look like a 700 because they were an authorized user, or because they got some stuff removed from their credit reports and things of that sort. And so that's why a lot of times they really care about income. Banks care about income. Are you making the money? The score is just going to get you in the door, okay? But the income is going to be the biggest thing. How long have you been at your job? Are you stable? Do you care about your stability of like the income stability more so? They care about those types of things, because in today's world, people will start a job, not like it, quit it, and just keep this whole flow going, and that looks unstable. They can't depend on that, and people don't even know. Little things like that is the reason why they have a higher interest rate, even though they may have a higher credit score.
So, Calvin, I can see that this conversation could go on and
It
on. You have
easily does.
so much advice and guidance. It's been a great conversation. Thank you for
Yeah.
coming on. Can you share your channel, your YouTube channel again with us?
Absolutely. Yeah. So just go to YouTube, just search 850 Club Credit. You'll see a video that works for you. Again, we make all different types of content that's related to credit. So whether you're looking to build your personal credit, build your business credit, we talk about, of course, credit cards, credit scores, bankruptcy. If you're new to credit, doesn't matter where you are. Even if you're like, oh, well, I know all that stuff. There's stuff that you may not know, because no, we've interviewed people with 50 plus credit cards, 30 plus credit cards. Some of the people that Lisa and I are friends with, we have relationships with these people. And saying that to say, they come on the show, every now and then as well. And then of course we always have something going on just to kind of like dive deeper, because like Lisa said, sometimes you need an hour or two, and sometimes people have questions too. So we always have different types of webinars going on. Right now, I'm not sure when this video is going to get posted, but we have our 90-day home buying challenge, and that's where we've helped thousands of people nationwide qualify for home ownership. And so that's one of the challenges that we have going on right now. Then we just dropped a video the other day, all of the credit score changes that's happening in 2025 that you need to know about, from credit score costs going up, to Trump trying to change some things with the Consumer Financial Protection Bureau. I mean, it's so much going on that people need to keep an eye on in the credit space. And then, of course, you can find out all of those things at park850.com, PARK850.com.
So, guys, just like with building your portfolio, you're not going to build your credit score or repair your credit score overnight,
Yep.
but we have to take it one step at a time. And by connecting with people like Calvin, you can, be on track, and we can be on this financial journey together to make sure that we are building a strong foundation for ourselves, so that when we want to do all of these things, buying the
Yeah.
home and the car and retiring with dignity, with enough money to live off of. We're
Mhm,
striving to
mhm.
accomplish all of these things. And by taking the time to put in the work over our building years, our young years, this is what we are trying to achieve for ourselves in the long
That's
run.
right.
So please make sure to like, subscribe, hit the notification bell for my channel as well as Calvin, so that you can keep up on all of this great information and be on track, so that we can be in control of our finances. So thanks for tuning in. And that's it for tonight. Good night.
Awesome. Thanks again, Lisa. See you soon. All
You
right.
too. Bye bye.